And it is in this context that the government is embarking on the most intense phase of the fiscal tightening. Now, I do believe that this chart just shows the gap between government spending as a percentage of GDP on the top there and tax revenues, the green line on the bottom. Ignore the dotted lines. That's just a comparison with the previous forecast made late last year. But you can see the size of the gap. You see the size of the gap that had to be closed. When you've got a budget deficit of 11% of GDP, however it's caused, it was caused in this case mainly by the financial crisis, you have to do something about it. It has to be closed. Action had to be taken. The only question was whether that action had to be taken quickly or slowly. This government decided that politically the only thing to do was to tackle it as quickly as possible. And I think there is, an argument in favour of that. I don't want to depress anybody unduly, but if you remember, the previous Labour government had two fiscal rules, one of which was that public sector debt would never rise above 40% of GDP. Now that rule was very quickly broken when the crisis struck, and this is an official projection of how long it takes to get back to that 40% of GDP. I can tell you the answer is 2032-33, and that is building in the tax increases and the spending cuts that have been announced. So the longer you leave it, the longer it takes to get to grips with government debt, and so that suggests that if you can act early, you should do so. And I think that is on the government's side in terms of doing this, because among other things, you don't want to go into, assuming we have hopefully a mild cyclical recession, in a few years' time, you don't want to go into that still with huge budget deficits. You want to you want debt to be coming down, and you want the deficit to be under control. The official projections suggest we will get to that point. So you see the bottom line there starts to head down before the end of the Parliament. That is one of the government's objectives. But, as I say, it's only on the basis that the unpleasant things that we know about, the tax increases and the spending cuts that we know about but mainly haven't experienced, do start to happen. There are risks around this. Of course, if the economy is weaker than expected, then debt continues to go up. Now, I think in terms of the weakness of the economy, the downgrading of the growth forecast, and so on, I think that was a non-story in the budget yesterday. I mean, of course, Labour has had great fun with the downgrading of the growth forecast at the time when the government launches its growth plan. But all of that downgrading really reflected what happened in the final 3 months of last year, when we had that unexpectedly weak GDP figure. It fell instead of being expected to rise in spite of the snow. Incidentally, I mean, the Office for Budget Responsibility, which looks at this pretty closely, thinks that the ONS, which produces those numbers, did get it wrong in terms of saying that, without the snow, even without the snow, the economy would be flat. They said yesterday that without the snow, the economy would have grown. It wouldn't have grown very fast, but it would have grown. And the important thing about the new growth forecast is that it entirely reflects the mathematics of, or the arithmetic of, taking out that fourth quarter growth. Growth through 2011 is stronger than they expected before. They expected quite a good bounce back in the current quarter and then steady growth through the year. Now, they may be wrong, and this is not a spectacular forecast for economic growth. In every previous recovery, we've seen at least a couple of years where growth is more than 3% a year. That is not projected in this forecast. But it's a decent economic forecast given the problems we've come through. I always say about these charts, they're called fan charts in the jargon, it's a great way of doing economic forecasting because you can never be entirely wrong. But it's the black line in the middle, which is their main forecast, and they don't expect a double dip. They don't expect they expect a moderate recovery, certainly not a rip-roaring recovery. And I think that's probably about right. That's how it feels to me. They also, this is obviously one of the aims of policy, and some of it is intended, some of it is unintended, but if one thinks about the shape of the economy over the next few years, then consumer spending is going to be somewhat weaker than we've been used to and will decline as a share of GDP. Government spending clearly will. When you're cutting government spending, that's got to go down as a share of GDP. Investment and exports have got to drive the recovery. Now, this, so far at least, the great export-led growth on the back of the devaluation hasn't been happening to the degree that we would have hoped for. It's been complicated by the fact that commodity prices have been going up, which is, when we import a lot of commodities. But we'd have liked to see something a bit more stronger than we've seen so far. All the surveys from the CBI and everybody else suggest that export orders are very strong and exports are doing well. The official figures are not yet as strong as that. And it's mainly a problem of import growth being too strong. Exports have been doing okay, but imports have also been very strong. Investment, again, investment intentions are pretty strong, so we've got to see that follow through in terms of investment growth. But this is, the great rebalancing of the economy away from consumers, away from government. If it can be achieved, if at the same time the budget deficit comes down, then we will have a better economy in 2015 than we've got at the moment. So, but we'll see what happens. Obviously there is always a doubt about economic forecasts, and particularly forecasts which are changing the direction of the economy compared to what we've been used to. In terms of unemployment, it was important that the government did something, the Chancellor did something in terms of the job market and in terms of youth unemployment. I'm always, it's not a popular thing to say, but when the Office for National Statistics tells us that we've got record youth unemployment, I am hugely sceptical about that because, for one thing, its records only begin in the early 1990s. We had, as you will all remember, much higher youth unemployment in the 1980s. And the other thing is about the composition of youth unemployment. If you are a full-time student and you say you're looking for a part-time job, you become part of youth unemployment. That doesn't seem to me an appropriate way of measuring the numbers. But, it's a political problem and the government responded to it. Overall, I think the employment and unemployment picture could have been a lot worse. And I just give you one simple comparison between what happened this time and what happened in the early 1990s. This time in the recession, the GDP, the economy, shrank by 6.4%. Employment only fell by 2.5% and has since been growing. In the early 1990s, it was a complete mirror image. The economy shrank by 2.5%, employment fell by 6.5%. So if you'd had the kind of relationship between GDP and employment in the most recent recession, you'd have seen something like a 20% fall in employment, which would have been disastrous, would have given us, true record levels of unemployment and so on. So it's been, I wouldn't underestimate the problems of people who've been made unemployed or people who are struggling to find work, but it's certainly not nearly as bad as it could have been. And this just makes the point I was making earlier about patterns of employment growth. And you can see, if you look at those yellow lines there, private sector employment falls very sharply in recessions, as you would expect it to do. Public sector employment doesn't. But during periods of recovery, particularly periods of long recovery, you get very strong growth in private sector employment in this economy. It's easily the dominant factor. I think a lot of people thought that, certainly in the Gordon Brown years, every job created was a public sector job. That certainly wasn't the case. Between a quarter and a third of employment growth was in the public sector over that period. Most was in the private sector. I think this can happen again. It may be that more help is needed to the private sector to do this, but I'm quite optimistic about the ability of the private sector to create jobs. The problem that we didn't expect to have, and certainly the Bank of England didn't expect to have, of course, is high inflation. Inflation, 4.4% on the Consumer Prices Index, 5.5% on the Retail Prices Index. The Bank of England expected that by now inflation would be about 1%. It wouldn't be a problem. There would be no question of pressure on the bank to raise interest rates because inflation would be below target, and you would have this very, very easy monetary policy, very low interest rates to offset the fiscal tightening. The effect of high inflation that we've got at the moment is twofold. One is that it puts pressure on the bank to raise rates, which I think they will raise rates, but I think they'll do it only gradually. But it also intensifies the squeeze on household incomes. And this is the unexpected squeeze. And the hope, and of course the assumption of both the Bank of England and the official forecasters, is that inflation will come down. But the official forecasters, the Office of Budget Responsibility, looks at an alternative scenario. You know, what happens if the blue line is if inflation comes down, the black one is if it stays high for longer. And that gives you a pretty bad outcome in the sense that interest rates have to go up much more sharply to combat that. Growth suffers, and when growth suffers, you know, public sector debt carries on rising, the budget deficit stays higher, and maybe that's when, you know, international markets lose confidence in Britain. So we do need inflation to come down. You know, there are some good reasons to expect it to come down. We won't have a VAT increase next January. One would hope that some of the upward pressure on oil and commodities drops out. But this is, you know, the unexpected challenge to the recovery, and to, you know, the kind of neat assumption that if you were tightening very substantially on the fiscal side, you would always be able to offset that with very, very ultra low interest rates, the lowest in our history. And so this is a little bit of a risk. Just summing up, I think, you know, although the budget was you know, about as strictly neutral as it could have been, you know, the net giveaway was not worth talking about. I think it was quite politically astute. I mean, the reaction this morning in the papers has been mixed, but generally more positive than the government might have hoped for. And I think some of those sort of, you know, some of the seed corn for a kind of enterprise-led recovery has been sown. Some of those things will take years, some of them we'll forget about very quickly, but most of them were reasonably positive. We are, I think, in a period of recovery. I mean, it's easy to get the impression that the economy you know, is still stuck in recession. It's not. You know, the first 12 months of recovery are actually stronger than the recoveries from the recessions of the 70s, 80s and 90s, though things have slowed down a little bit since then. It wasn't a budget for jobs in any meaningful sense, but then I suppose they never are really. You know, if you were looking for labels around budgets, they're either going to be budgets for growth or budgets for jobs. Most of them aren't. This one wasn't really, but there are one or two things which, at the margin, may help a little. And I do think, you know, although the constraints were quite powerful, it was about as enterprise-friendly as it could have been, given that there wasn't any money to play with. To cut corporation tax at a time when the public is in the middle of a pretty intense fiscal squeeze was quite a politically brave thing to do. So again, that was pretty positive. That's my take on it. I'm very happy to respond to any questions. Thank you very much indeed.